please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to a fresh new edition of Taking Stock. Well, this is the show where we look back at the week which has gone by and look ahead and try to tell you what is likely to happen. It's a tough thing, but we nevertheless try to do that, look at the market from all angles. I'm Prashant Nair. With me, as always, my colleague Surabhi Upadhyay. Hi, Surabhi.
Hi, Prashant. Interesting week for the market. Pretty range-bound, a couple of sectors churning around, moving around. We'll cover all of that as we go forward. In fact, before we introduce our guests on the show, let me quickly just wrap up the action of the week gone by. So on the indices, the headline indices, what do you have? You have about a 0.7% increase on the Nifty. So despite the chop and churn, optically the index is higher. The mid-cap index is also sort of just very, very range-bound. We've seen about a 0.5% increase come through. The banks have been the big story of this week because that is where the weakness started to set in. And the Nifty bank was down 1%. If you're looking at private sector banks, the Nifty private banks, then that index was down about 1.3% thereabouts. Individual stocks like ICICI Bank, for instance, falling 3%. And that is the big question on the street, that this whole corporate bank rally that we saw, big PSU and corporate bank rally, whether that has run its course, whether it's taking a breather. So these were some of the talking points. Just quickly talking about some of the other major newsmakers. It's the season of buybacks. So L&T has joined the bandwagon with that massive 9,000 crore rupee buyback. That's been one of the key stocks on the Nifty, up almost 6-7% for the week gone by. And hopes of a buyback on Friday were firing up even a BHEL. That stock ended almost 8% on the higher side as well. While there are promoters buying back shares or companies buying back shares, there's also been a lot of chop and churn with respect to big investors or promoters paring down their stake in companies. So one such instance was Mahanagar Gas. The other such instance was Hexa, where Baring's PE is selling down stake. So these were the other big newsmakers because promoters are at least partially reducing their holdings. Finally, it's been a good week for Reliance once again. Again, historic levels for that stock, blue sky territories, 8 lakh crore rupees of market cap. That's the headline you got this week. And the rupee's weakness was, of course, a very key theme within the market. And the way a lot of traders were playing that was, of course, lapping up on some IT names and pharma names for sure. The pharma index is up almost 4% for this week. So pharma continues to be one of the most loved sectors, Prashant, at least for now.
Oh, yeah, and I think rupees have been a pretty big tailwind.
Yeah.
So let's also now sort of set things up in terms of what we are looking ahead. I mean, remember, the market has been, you can say that the Nifty did not sustain above the 11,600 mark, but the fact is for the week we are up about 0.75% or so on the Nifty. So we are gaining altitude, and as you gain altitude, the air gets thinner, and as the air gets thinner, I think it becomes more prone to accidents. I mean, same is the case with the S&P 500 as well. We highlighted earlier in the week that the S&P 500 is now essentially in its longest winning streak. I mean, it's not seen a bull market so long ever, right? So let's start with the S&P 500. If we can have the graphics up. I'm saying this for the first time in many weeks. I've been saying for weeks on end that the S&P is on track to making a new high. In the week gone by, it has actually made a new high. It's crossed the sort of record for the longest rally and it's also made a new record high. But as I said, I'm highlighting the fact that it's now showing signs of some fatigue. The reason I'm saying that is because for the last 2 weeks, the number of stocks which are hitting 52-week highs, not just on the S&P, actually more than the NASDAQ as compared to the S&P, I mean, that ratio is starting to come off a little bit. It's a very imprecise indicator to I mean, this is a weekly kind of a look back and look ahead. It doesn't really work in a weekly kind of a time frame. But, it does. It is a short, good indicator of whether the market is starting to tire out a little bit. You tie that in with that record of the longest ever bull market, I mean, you start to sort of get somewhere. The US 10-year yield, which has been moving higher, which people were talking about 3.05, 3.1 kind of levels. It doesn't look like it's actually going to those levels now. It looks like it's putting a top in place. I mean, technically speaking. So the S&P starting to maybe look a little wary. The 10-year, which has rallied along with essentially on optimism, on data, on record profits, on tax cuts, etc., along with the equity markets, that's starting to look like it's putting a top in place. Not a very good picture. The dollar, let's come to that. The dollar typically weakens going into midterm elections, which are not very far away in the US. So that is another thing to keep an eye out on. Now, when we talk about the dollar, people talk about the DXY, but the dollar, the word gets thrown around. The point is, what is the dollar going to strengthen against and weaken against? Typically, into U.S. elections, it weakens against other G10, actually even the G3 currencies, and not really against emerging markets. What you want to see is it weakening against emerging market currencies, which doesn't really happen. So again, it's a bit of a mixed picture on the dollar. Oil, I've been saying for a while, the overall setup looks bearish. I mean, it can get pops, etc., but the overall setup looks bearish. 63.5 is the support. It actually got to 63.5 recently, and then it sort of bounced back. Let's come to India. I think finally the realization is setting in that 69 is kind of the new normal for the rupee, the dollar rupee, 69.70, that kind of range. I don't think anybody's expecting this to sort of keep going to 71, 72, but it should stay around this range. And if that is the case, it has got implications, as Survi was pointing out, for pharma, IT, how much more outperformance, etc. And the Nifty itself, it continues to march ahead. It failed to sustain above 11,600, but it is up this week. It made a new record high above 11,600 on Thursday. So, I mean, as far as the market is looking, is gaining momentum, is gaining strength. No reason to really doubt it. But I would say overall, looking at this picture, as you keep gaining altitude, I think one needs to sort of, watch any incremental development, which may be small when markets are lower, but may gain sort of more significance at levels that we are actually trading at, not just here in India, but around the globe as well. Survi.
Absolutely. And one of them being the way oil prices are moving, because one thing we saw this week was, as you were talking about it, that's been one variable that's kind of started moving to the upside again. Well, let's discuss all of these cues with our guest on the show. Joining in to talk about the market this week is Ratnesh Kumar, MD and CEO of Buyback. Great to have you with us on the show, Ratnesh. So, looking at the setup and where we are, it's been a big rally. It's been a rally that's slightly broader than earlier. But are we running into headwinds, or do you think that the current momentum can actually even take us higher?
So, in the overall context of the market, I think the market is still, the rally is fairly narrow-based. Driven by a very, very select few sectors, and especially on the large cap side. And what is playing out at present is that the corporate numbers, earnings have begun to come through, quite in a positive way. So the companies have begun to do better. Some of that is also the base effect which was there from last year of GST and demonetization. And overall, the activity and the growth being seen in many of the sectors, many of the companies, overall corporate earnings is supportive for the market. Whereas at the same time, you do have these other headwinds which are there, be it on the global side, oil, rupee, etc., as well as locally in terms of what is there on the monsoon and the elections ahead. So yes, and the market is about little about one standard deviation ahead of the long-term average on valuation. So it is not cheap. So it is in a kind of in a middling zone right now. There is you can say a little bit of a tussle between improving corporate fundamentals versus the macro factors.
Mm-hmm. So what is your own opinion? You've been in the market a long time, Ratnesh. You've seen cycles. I mean, so where are we at? Are we at the fag end? Are we in the middle? Where are we at now?
No, I think this year is going to be a year of moderate, subdued sort of returns. Simply because some of the, you can argue that some of the corporate earnings recovery is being priced into the market from where the valuations are, and those on the global side, be it the dollar, oil, or local political sort of events over the next 6 to 12 months, those will remain. So I think this year is going to be probably a 5 to 10% return kind of year for the market, which is I guess in the context of recent history is not very high, but it is, you can say, a consolidation period for the market.
We are up 10% this year on the Nifty, Ratnesh.
Yeah, so I think so I think if we exit the year in and around current levels, I think it'll be a fairly good outcome, good performance for the market.
What about earnings, Ratnesh? I mean, the first quarter has given the year a nice start. I guess barring some of the banks which have issues, and that's well known. Consumer companies, for instance, they've come out with some great numbers. So how do you view the earnings trajectory, and could that give further impetus to this rally beyond the sort of levels that you're speaking of right now?
So earnings during this quarter, which just got reported for June, I think you can look at three factors which gave it a boost. One of which is the base effect from last year, because June quarter last year was still the destocking phase for the GST. Second is you had a little bit of a boost from the rupee weakening, and third was because the oil prices going up. There were some inventory gains which were there in the oil companies. So when you're looking ahead, I think clearly the pace of rupee weakening and the oil price increases that you saw over the course of last quarter, that will not be there. But overall numbers, I think for the year as a whole, certainly you could look at 15 to 20% type of earnings growth finally coming through after many years of such expectations, which ultimately get belied in the second half. But I think you are well positioned in the market overall to get 15-20% return. First quarter was around 20% growth in earnings, but because of also helped by some of the one-off factors. Going ahead for the remaining 3 quarters, what you will see is the bank's performance getting better, because a lot of the provisioning pressure is easing off, and naturally growth in many sectors is coming back. So both of those factors should mean that for the year as a whole, we will still get to around 15-20% earnings growth number as we saw in the first quarter, despite some of the one-off factors not being there.
Fair enough. I mean, when we spoke with you in June, Ratnesh, actually, you were bullish on steel, cement, auto, domestic consumption. We'll get to those in a bit, but just stick with banks for a bit more. So are you saying that there is a big opportunity here? I mean, maybe essentially corporate-facing banks. Axis, in the very near term, looks a bit overbought, but it's coming out of a long period of underperformance relative to the market. ICICI Bank, maybe a Bank of Baroda. What's your sense?
So I cannot comment on my parent bank stock, company or the stock for sure.
Okay.
But overall, I think if you look at the banking sector, over the last 4 or 5 quarters, you had especially the provisioning numbers coming through much higher than what was being estimated. Some of that could have been because of changes in regulations, and some of that, but that I think has peaked out. Overall provisioning numbers for the sector has certainly peaked out, and you are beginning to have some progress in some of the resolutions. So one of the things which will be kind of positive for the banking sector when you look 12 months ahead is that the provisioning numbers on a 12-month ahead basis will be vastly different versus the last 12 months. Secondly, I think you also had growth numbers not being that healthy, which is also coming back now within the banking sector. So I think when you look at the market overall, you have, especially amongst the select sectors and stocks which have kept the market at all-time high levels, the valuation differential between what has kept the market high and the others is quite high. And one of those others where you still have valuation on your side is on the banking sector, especially the ones which suffered because of heavy provisioning, etc. So I think you certainly on a 12-month basis can look at outperformance from that segment.
Okay, so then would you be referring more to PSU banks, or you'd be largely sort of more comfortable with some of the private sector banks that do a lot of lending to corporates, some of the likes of ICICI, etc., Axis, where there's also management change, there's a lot going on. But is that the side you'd be more comfortable with, or would you even look at PSU banks?
So I think you would probably want to sort of differently categorize. I think you just categorize it as strong banks which are active, growing, be it in the private sector or the public sector. And there you will find that the corporate heavy banks are at a steep valuation discount. Naturally, the retail heavy banks will continue to grow. They deserve their valuation. I'm not saying that needs to come down, but the corporate heavy banks have had severely compressed valuation, be it on the public sector or the private sector, and that segment overall is I feel there is a scope for substantially improved numbers going forward, and as a result you can get lift up in the valuations as well.
Mm-hmm. Yeah. What about something like cement? I mean, if one is to look at cyclicals, this week the big talking point obviously was this L&T buyback. So if you're looking at construction, infrastructure, or a related play like cement, would this interest you as well in the market? Cement stocks, for instance, have been having a great run. I mean, they seem to be sort of now coming out of a long period of correction.
Yes, I think overall, one of the themes that you do want to play in India going forward is I think, probably a huge shift change which is currently undergoing in the real estate and housing sector with the onset of RERA, and that is driving on the ground huge consolidation in favor of stronger developers, getting the sector more organized, and hopefully getting the trust factor back as well. And so I think housing is one segment which to me it looks like it's a great play over the next few years for the long term. So naturally cement gets some benefit from housing as well as from the infrastructure side, and it is a good play on that. But a more direct play, I think, would be quality developers which emerge stronger from this consolidation phase, which is there in the industry, consolidation, cleanup, all put together phase which is there in the industry. And naturally, at present, the volumes are not back, but it's only a matter of time. And secondly, I think in the home building space, that's another segment, which is more of a direct play, versus cement. Cement is housing as well as infrastructure, both put together. So home building segment is another segment which I think looks pretty well poised, for the next 1 to 2 years.
Okay, so that is the view coming in from Ratnesh Kumar. We're out of time, Ratnesh, but great to have you on the show as always. Appreciate you joining in, and have a good weekend. We'll see you back over the next couple of weeks. Okay, we are going to slip into a very quick break, but we'll leave you with some market opinion that we heard through the course of this week. When we come back, we'll get you a technical check on the market. Ashwini Gujral with his assessment of things and the way we left off on Friday, and his view for the week ahead.
When you look at forward multiples, the markets may look at above the long-term average multiples, but the earnings growth cycle is what it is more excited about right now. And as we have seen the disappointments in the last 7-8 years of down cycle, we may be up for surprises in this up cycle also.
Generally, if you're a small investor out there, it's time to be circumspect on valuations. Those who have the easy money in this rally is clearly made, and we are facing a challenge on the macro front, especially on currency and on liquidity. Liquidity is courtesy America. The currency challenges courtesy our own very robust consumption.
Compared to the situation what was about 6 months ago, at the end of calendar year 2017, when mid caps and small caps were on a roll, I think the main deterrent was basically valuations, and at that point in time, valuations were completely untouchable. Since then, we've seen a fairly decent amount of correction in the mid cap and the small cap space. The index itself has corrected quite meaningfully, and then individual stocks have done even more so. So I think now at least we are in a position to assess some of the companies that we liked earlier but were unable to buy. We'll get a fairly decent chance to build a position in the mid and small cap space for an eventual return target of 2-3 years and beyond.
Welcome back. You are with us on Taking Stock. Joining in now is Ashwini Gujral. Let's take a look at the technical setup of this market. It's been slightly range bound with a incremental positive bias. So, Ashwini, we are still up 0.7% on the Nifty. The banks have taken a bit of a backseat. How do you sum up things?
See, I believe that there is a lack of follow-through that's coming in, beyond 11,600. Now, till yesterday, consumption, FMCG, etc., they were holding up the market. But today, with banks and IT both going down, you are now basically left with Reliance, which is trying to show some sort of upside or hold up the Nifty. Banks have continued to show follow-through on the downside. And somewhere it looks like the bank Nifty is ready for a correction, which could be a multi-week correction, 2-3 weeks, because corporate banks have had vertical rallies, and they look like they could correct given the worsening of the macros. Also, crude looks bullish, and the rupee looks fairly weak. So that sort of combination should allow the market to correct some, and that will only make it stronger. So where can Nifty go? Possibly, I won't be surprised if macros, etc., get weak enough that you get back to that 11,250, 300 type of zone, and from there the Nifty starts to move higher. Similarly, on the bank Nifty, maybe 27, 400, 500. That seems to be likely. Although I would expect the rupee sensitives to continue to move up and maybe hold up the market. But overall, the market seems to be tiring out a bit, and this week the clear feature was that we failed to stay past 11,600.
Okay, so Ashwini is saying more downside. Ashwini, in terms of trades for the coming week, what would you recommend?
See, everybody is looking at pharma, but more domestic pharma, but the MNC pharma is showing extraordinary moves. Pfizer, we saw, went up 17% on Friday. You have AstraZeneca, which is moving up. So I guess, that is where the bigger bull market may be there, because absolutely nobody owns MNC pharma. So that looks interesting. AstraZeneca is a buy with a stop of 1860, target of 1940. Sun TV is again failing on the upside. So this is a sell with a stop of 775, target of 750. And Titan, I'm afraid to say that it may be topping out, because this time the rally that we had has failed to get past the previous rally. That often makes for a head and shoulder style pattern. Now, where can that go? That can possibly go towards 700, 750 over a period of time once the 850 zone starts to break down. So on all rallies, now Titan is an exit.
All right, Ashwini, thanks very much for that. Appreciate you joining in with that technical take as far as the markets are concerned. So it'll be one more week done. Ready for the next one?
Well, the weekend first, and then absolutely we will see you bright and early Monday morning with the markets. Have a great one.